I'd like to thank our partner for today's event, Metro South Chamber of Commerce, as well as Rockland Trust Bank and U.S. Pavement. Some of the people you have seen during the networking. I'd like to thank our sponsors for today, which is Rockland Trust Bank, and our annual sponsor, which is U.S. Pavement Services. We thank them. We can't do these events without their support. There's a lot of pieces that go into play to put together an event, so we appreciate the support. And then, voila, this is me. I'm Rick Kaplan, and I produce all these events throughout New England and New York. And anyone that is interested in being part of any of our events, you're more than happy to connect with me. With the New England Real Estate Journal, you go to nerej.com and you can find my information, all our stories. You can even see a lot of the interviews we do. We do interviews with companies all over the country, and that's also on that website. And this is the New England Real Estate Journal. If a lot of people aren't familiar with, it's almost 60 years we've been around. So we're doing something right. And we offer quite a bit of information on commercial real estate. We go to pretty much all over New England. And we have an array of readers from the commercial real estate industry and companies that are connected. So if you want more information and subscribing to the journal, please contact nerej.com. All the information is on that page. And at this time, I want to introduce the president of the Metro South Chamber of Commerce, Chris Cooney, which you had just seen on the networking. Chris is going to say a few words, and then he is going to introduce the panel. Oh, did we lose Chris? Where'd he go? Oh, I think we might have.
Can you hear me now?
Yeah. Oh, there you are.
Okay. All right. I got moved over to the.
Oh, you got me. You got
to.
All right. Now I give you Chris Cooney in person.
Hey, thank you very much, Rick. And I want to thank the Real Estate Journal for partnering with us and being able to produce programs like this. It really takes programming that we do locally and regionally and expands it into a much larger audience. And of course, that's what we're here for, is to promote the region and promote all that is great about the Metro South region. And we can't do it without partners like you. I do want to remind folks that in October, we're going to be featuring Metro South in the New England Real Estate Journal. And as we mentioned, please get your profiles in for that as well, so that we can have a great comprehensive pullout section featured next month. I also want to thank Secretary Mike Kennealy for his leadership in support of the regional economic development initiatives in the state of Massachusetts. Programs like this are possible as a result of the state's support of regional economic development organizations. We have a great panel who I also want to thank, but also I want to hear from them, so I'm not going to take much time here. It is my pleasure to introduce our moderator today. He is the chair of the Chamber's board this year. He's just completing 2 years. Fred Clark. Fred is the president and CEO of the Bridgewater State University and has had a long, proud history of public service. Born and raised in Brockton, serving the congressman for many years, also on many civic and community boards over those years. Holds a degree from Bridgewater, where he is president, also a law degree from Suffolk Law School. He's 12th president in the long, long history of Bridgewater State University, and I'm happy to introduce Fred as our moderator today. Fred?
Chris, thank you very much. I want to thank you for your leadership, Chris, not just in recent days, but over the past couple of months and years. And it's a real pleasure to be a part of the chamber. I also want to thank the New England Real Estate Journal and you, Rick Kaplan, for your leadership. It's great to be here on this important topic. I don't know if the mayor, Robert Sullivan, the mayor of Brockton, was able to join us, but we do expect him to pop in and listen in for a little while as well. And I do want to say it's great to see everyone on the Zoom squares. Bruce Hughes, I was on a call with you last night, Bruce. Typically, Bruce's voice is smooth as silk, but now it's gravelly. And I told him last night, when I heard his voice, I wanted to reach for my mask. But I'm glad he's okay. And Rob May, your 7-layer dip sounds delicious. Tom Keys, I look forward to the book and then the movie. But it's really great to see all of you here. We come together around a really interesting topic. How has the pandemic impacted commercial and residential real estate in Boston and Metro South? And will Route 24 and Route 3 corridors benefit? We think that they will. It's a bit of a theory, I guess. We're extremely interested here at Bridgewater in the answer to that question. We own 25 acres in the Plymouth Industrial Park that was given to us. So I'm sure we all have an interest in listening to our panel. And on the panel, you saw those great glamour shots of everyone. It's really an MVP panel. Truly, and we have, I think, all the right people to talk about the right issues as we go forward through the course of this morning's presentation. I want to get right into it. And we have with us, and again, all of the biographical information for each of the presenters has already been presented to you, so we won't get into their biographical. We want to get right into the substance. We're going to start off with our commercial realtor who's with us, David Ellis. And David's going to walk through some of the trends, the data, and hopefully give us some insight and advice into this issue over the next 10 minutes or so. And with that, Dave, go ahead. Why don't you take the floor? We look forward to hearing.
Excellent. Fred, thanks so much. And thank you to the Metro South Chamber and the New England Real Estate Journal. Have been a great partner for us over the last couple of years. I won't get into the biographical. We'll dig right in here. So I'm going to be covering quickly just some industry trends that we're seeing in the retail, the office, and the industrial sector, leaving the interest rate development stuff towards other panelists here. But if I could, I'm going to try to share my screen with everybody here. And I need some permission to do that, I think, from the MC. There we go. Thank you very much. So as everyone can see, I'm going to kind of start with the retail and to echo some of Rick Kaplan's sentiments earlier. When the pandemic first started in March and April, you know, we tightened up quite a bit. We were concerned about the year and what it would bring. And I will say that I'm very positive and bullish in the commercial real estate market south of Boston and suburban Boston. So you know, we've seen some trends over the last few months. I think that the big thing across the board between all these sectors is really just the uncertainty. There's still not enough evidence here. There's a lot of businesses that have not made these tough decisions to either leave the city or change their business, but we're starting to see that now that schools are kind of coming back to some extent. And so I want to get into the retail piece. I mean, the big thing that's kind of helped prop up the retail industry has been the PPP, EIDL, stimulus dollars that we've seen. And as the PP funds sort of start to diminish, we're seeing some of the effects of the summer's over, cold weather's coming. And I don't want to make this a negative piece, but I think we're definitely going to see you know, some of this, the retail get affected by this, specifically restaurants. There's been some data to support that, you know, one in four, even higher numbers could close between now and the end of the year on the restaurant side. But also the experiential retail, which is sort of like a segment of retail, gyms, movie theaters, places where people congregate. Those groups have been impacted the most and are having the most trouble staying in space, paying their rent. And this is going to be something that, well, you know, we hope it's a short-term thing. It could have long-term consequences for the market. So what we're seeing out there, a lot of larger box malls get impacted, but the neighborhood and grocery anchored retail has been relatively stable. And I gave some graphs here in terms of the absorption rate, which is effectively the velocity of leasing in the retail segment. This is specific to Route 24, and this is actually going back to 2008. As you can see, from 2016 to 2019, you've got some negative absorption. A lot of that is malls and conversion of mall spaces as e-commerce has sort of taken over the world in terms of where people purchase their goods. But they still maintain the service and experiential retail was kind of coming up at that point in time, but now it's the hardest hit because of the pandemic. Also showing some rent growth numbers where you can see the rent growth even before the pandemic. Excuse me. Year over year, 2019, you start to see it dip off, and now it takes a sharp dive year over year from 2019 to middle of 2020. So some numbers that, and I can share these slides with the group as well. Moving on to the office market, I think Chris touched on this a little bit, but what we're seeing, the numbers show there's obviously a flight from denser urban office markets as employers are taking stock of where their employees are, where they're working from. So you'll hear a lot of this hub and spoke model discussion where you're seeing companies maintain a central presence. Maybe it's a smaller footprint inside 128 and inside Greater Boston, where you'd have a satellite office somewhere outside the city, whether it's a Brockton or a Plymouth or a Quincy Braintree. So closer proximity to workers. I know a lot of workers like this. I think this is going to be a cultural shift long term, where you've got remote workplace via Zoom, a place for people to work and collaborate. But people still like going into an office. I think productivity is heightened in an office environment. So it just remains to be seen if these companies are going to put all their chips into the suburban pot, if you will, and go all in on the suburbs. But we are starting to see that down here with companies moving down here at a pretty good pace. So the office market I'm down here in the suburban Boston, I'm very bullish on. Rent hasn't really been affected too much in this area. I don't necessarily see it growing, but I see it being stable. The types of office space environments has shifted as well. Over the last 5 years, you've seen a lot of co-working environments where you've got a lot of shared common area, and you're seeing these WeWorks or WorkBar, Regis. They're going to more of a private office, lock and key office spaces. So they're putting a lot of money into their fit outs to have separation for the companies that are here versus just open collaborative space. Just kind of moving on to, the industrial sector since the start of the pandemic has really not been hurt. And in fact, it's probably grown to some extent. So it's really helped keep the commercial real estate market alive. And I think a lot of the bankers and lenders and developers even will tell you that they're the strongest area of the commercial real estate market is this industrial sector, from Boston down 495, 24, Route 3. So you'll see that some of the net absorption numbers, the rental rates have stayed pretty high. The vacancy has been very low. It's very difficult to find industrial space. The supply is low. Demand is obviously high, and with this low interest rate environment, a lot of companies are trying to identify locations that they can purchase versus lease, and it's definitely kept the values up. I would even argue that they've increased the values of industrial flex properties across the board. And I don't see that changing anytime in the next 24 to 36 months. In fact, you've even seen some of these bigger box power centers, retail vacancies converted to flex warehouse. And I think that could be a trend in the next 12 to 24 months as well. So that's my overview of the market in a nutshell. But I wanted to kind of just go over just a quick summary, conclusion, and then some advice for those businesses that are out there kind of looking around and looking at their options. This is a cultural shift, for businesses. Remote working is not going away. Zoom calls are not going away anytime soon. I believe that it's here to stay, and it's going to create some opportunities. So definitely some short-term market opportunities in the Boston suburban leasing markets, subleasing markets. But we're also seeing a lot of entrepreneurs too. I think that's something that everyone needs to pay attention to. Is there's a lot of entrepreneurs that will be born out of this pandemic as people look to get out of their 9-to-5 job and work for themselves if they're going to be in this area. So I would look for that. I would look for shifting business models as well. Obviously, with change comes shifts in business models. So pay attention to that. As far as businesses that are out there, we're having a lot of questions related to, hey, I have my lease coming up, and what do we do? Do we go something long term? Will landlords give us a long term break? And I think at this point, you need to seek relief, but it'll be in a short term relief piece. Whether it's deferral, whether it's writing a shorter term lease with your current landlord. Looking outside of the space that you might be in, there may be some opportunities perhaps in the subleasing market, so it's something that you might want to look at. If you're a landlord, property owner, you need to work with your tenants. You need to have these hard discussions with your tenants. I've had a lot of businesses come to us and say our landlord just won't work with us, and I think it's really short-sighted. We're all in this together, and there's a lot of change happening at a very rapid pace. So it behooves you to work with your tenants, or explore some potential, repositioning of your properties, which is eventually going to start happening. But I think that's sort of my presentation in a nutshell. I hope I stayed on time, and if there's any questions that I can answer outside of this forum, I'm happy to assist and talk to anyone on this group.
David, thank you for that presentation. And there's so much data right there, and we could go deep, I think, for every single panelist. And we're going to try to give everyone a bit of a smorgasbord of information. If you do have a question, put it in the chat, and what we'll do is we'll try to get to questions at the end if we have time. And Mr. Secretary, thank you for joining us. We're glad that you're here. We're building up to the crescendo of the secretary at the end here, but
great to be here.
Oh, it's great to have you, and thanks again for being with us. We're going to shift gears and go to the lender banker perspective, and our friend Gerry Nadeau, the president of Rockland Trust and the chair emeritus of the chamber as well, to talk about trends, any examples he sees that indicate shifts or opportunities, and anything you might want to add with a mixed-use development focus as well. Gerry? Gerry, you're on mute.
Can you hear me now?
Yep.
Oh, great. We're all being very disciplined to mute up. When you're not talking, put it on mute, so I apologize. Maybe first, just on perhaps at the highest level, and I'm going to focus, this is really just about commercial real estate and residential development, not about, general corporate banking. So probably the three highest, macro trends are interest rates are lower, demand is softened, so the demand for commercial real estate loans has softened, and banks have likely tightened credit. So those are probably the three most high-level observations that I have seen. But maybe a little bit more specific, and maybe first try to be on the positive note what's happening. And first, and it's probably, at a level that I never would have thought I would have witnessed, and that is the increased demand for new homes. These are new homes in largely suburban locations. They can be condominiums, although more preferentially townhouse or duplex style versus a garden style, a multi-floor. It is just unprecedented. I mean, in our business, we have a geography that is essentially all of Eastern Mass, all of the Cape, 2 islands, and much of Rhode Island. And it is universal, this demand for anything new. It is absolutely astounding. It is probably stronger now than it was back in 2005 and 6. And its price increases are happening almost daily on them, partly driven by increased cost. The cost of building a new single-family home is appreciated considerably because of lumber. Lumber may be up as much as a third or more, particularly pressure treated. The whole series of reasons, maybe it'll dissipate later this year, but at the moment that has made a big difference for a lot of builders and developers. So we're just seeing this. I mean, I've had developers report down in southern Plymouth that their sales have tripled. We were talking to someone in Situate the other day with a new project, and I think they put 10 homes under agreement in 10 days. Just unprecedented activity. Second homes as a subset of that, equally strong. And again, mostly Cape Cod, the islands, and parts of the summer locations in Rhode Island. The demand for those are both existing and new have just been widespread. And this summer, if you tried to rent a house in the Cape, you might know what I'm talking about. They became impossible to rent once July rolled around. Maybe shifting a little bit, talking about apartments. It's sort of interesting on apartments right now. I think there's still developer interest in building apartments, and we are certainly fielding some inquiries. And many of them make sense. Where I would say there's probably been a change is in the cities. I think everyone right now is taking a pause on development of apartments when they can in Boston and Providence, trying to understand what the market is really doing. The Globe had a report, I think it was a week and a half ago, that as of the 1st of September, there were 13,000 empty apartments in Boston. The first time, I think Rick probably remembers maybe how long ago, maybe that were that many empty apartments at the time of colleges starting up again, to see that. We're hearing, and it's still hard to put a finger on to be completely sure, but anecdotally, we're hearing that vacancy rates have doubled. Now they've doubled from 5% to maybe 10, 11, or 12%, again in the city. Now some of that probably has been driven by students not going back to school or choosing to stay home and study remotely. It may be others that they either have lost jobs or have just simply chosen to go live someplace else. So it's still a little early to tell, but there's quite a change there. Similarly, on condominiums, one that was particularly telling to me, and again, as reported by the Globe, was that the inventory in the Back Bay, I think this was as of August 1st, was double what it was a year earlier of new condominiums for sale. So an appreciable increase. Certainly some of that's driven by new construction in the Harrison Ave, that area of the South End, closer to the highway, but nonetheless, a significant increase. So I'm not sure what the implications are for that, but I think it's causing lenders to probably pause as they look at city development right at the moment to better understand, is it going to be like Rick said, are people going to come back to the cities for work and to live or not? I think it's a little too soon to tell what's going to happen. Industrial, that was just mentioned a few minutes ago, and David mentioned. And industrial loans are, there are few of them out there because there's very little existing inventory for sale. Those that are out there are being gobbled up. The only one of substance, there's probably two. There's one in Bridgewater, it's about 300,000 square feet, that's brand new construction on Elm Street that I think was built on speculation, that's sitting vacant. It's a very modern tilt-up concrete building. And then over in West Bridgewater, there's a company, empty buildings where off of Manley Street, I guess that's Manley Street, and they were occupied by some companies that relocated elsewhere. So I'm not sure where those are going to head. They're somewhat older, lower height buildings, but I think the demand, again, seems to be very, very strong. Maybe some of the last thing, just to comment on positives, is the mall conversions. Again, David talked about the reduction in absorption on retail. And the ones that I think, those of you that have been down route, I know it's not in Metro South, but over in Hanover, much of the Hanover Mall has now been torn down. That was a mall built by the Campanellis and the Tedeschi's back, I guess, in the 70s, late 60s. And most of it's now been torn down for redevelopment, for mixed-use development. Not sure if it's all going to work the same. And then the Taunton Mall was sold at auction to a developer. I guess that was probably late last year for a very modest amount of money. And rumors are that that's either under agreement or soon to be someone to redevelop it for industrial commercial development, including raising many of the buildings. So I don't know whether that's going to come to fruition or not, but that's the expectation. Trends just on maybe on the negative a little bit for banks, and there's plenty of other bankers that know better than I on the line, but I suspect that most of us are avoiding loans on hotels, hospitality and restaurants, entertainment, whether it's bowling alleys or movie theaters, and perhaps even on offices until we get a better feel for what's going to happen. I do think that ultimately the office space configurations will change, but in the interim, it's hard to know which ones will be changed and which ones will become obsolete and not used again. I just don't know. There is a building down in Cape Cod in Hyannis that's just recently completed by a local company on the Cape with a completely open work environment, and they've been unable to occupy it at all. It's just sitting completely vacant. They spent a considerable amount of money on that, but they adopted one of these open work environments, almost that picnic table style, with everyone just basically spreading out in a long row, like in a cafeteria, and they're not comfortable, employees are not comfortable, and management's not comfortable having their employees in it. So where does that go? I don't know. So I think office is a little tough right now to determine where it will be. Much of Metro South has a nominal amount of office space. I'm sitting in one of those buildings right now, but and I know when we look for the space in Metro South Route 24, there isn't an abundance of it available. So I don't think I don't think we're going to see a lot of new construction. It'll probably be more around what we see happening over in Quincy. There's some vacant space over in Rockland and Hanover. But we shall see. I guess, it goes without saying, for the same reasons I talked about making loans in Boston on apartments or condos, I think most banks are taking a pause on that at the moment. Whether it really makes sense to add more supply in those markets, likewise for Providence. So I think most are of the mindset that it's time to sit back and wait to see how that plays out. And then maybe just talk about maybe what else are we seeing that's maybe happened differently or been accelerated because of what we're facing. The first is, it's been interesting. None of them have been started because of COVID, but they've been completed, and that is sort of buildings that have live-work units in them. So by happenstance, these are developers that had built something that had either some level of those units have just been over the top successful. As you might imagine, most apartments don't have the room for someone to be able to operate a business or be online with their employer all day without interfering in someone's bedroom or back of the kitchen. And for whatever reason, these live-work units really lend themselves so well to working at home. So they are most often either in new construction in areas where the rents are sufficient to be able to justify, or in some of the older mills. And the mills still seem to be the most attractive option for them because of the nature of the wide open spaces in them. But that is one that certainly has changed. As I mentioned earlier in my comments, the suburban homes, it's just the shift there to focusing on people. Basically, the tear downs, I think, have accelerated in some of the suburbs around Boston because of the pandemic. And people that previously would have thought about buying a new condo in Boston are thinking a little differently. Hotels to be converted to apartments. Already, some owners of hotels that have nominal levels of debt on them are considering converting them into apartment buildings. The costs are not that significant. It's tearing down interior walls, but typically they have the right amount of windows in them. They have hallways in them. They have lobbies in them. They have parking. So they do lend themselves, and I think we will see that they will be converted in markets where there's too many hotels. the hotel demand in this country beyond the vacation travel, and I think the vacation hotels are a little different. The business travel hotels are going to be challenged as long as there is not business travel in this country. These being, the Marriotts, the Hiltons, the Hyatts, et cetera. There's no one's flying. There's no company encouraging business travel. So many of them are operating, with 70% vacancy rates. The city of Boston, many hotels are closed. Some have been rented to colleges. Some have been rented to the city of Boston for housing homeless people that have health issues. So I think that will accelerate this whole concept of converting hotels to apartments. And then I guess the last thing, just touching on vacation homes, there aren't enough vacation homes, it seems, for all the people that want them. So I think that's going to really drive up some of the values, even beyond what we've seen already. I was just talking to a developer the other day. They sold a house in Martha's Vineyard in Edgartown in December for $5.3 million. That buyer now has it under agreement for $6.2 million, having just used it for the summer. And these are smart, sophisticated developers. One of the partners is a longtime island broker. They're just in shock that the house can be retrading for that much money. So I think, unfortunately, for a lot of families that, for good reason, are not going to be comfortable traveling, maybe for some time internationally, looking to buy a second home, I think is going to be much more expensive. And then maybe the last thing, just to take a minute on, is just talk about, sometimes we hear a lot now about mixed-use developments. And that is what I mentioned. Hanover is hoping to see happen at the former Hanover Mall. The challenge with mixed-use developments, there needs to be sufficient rent, market rents, on all the mixed uses in that development for them to work economically. It can't just be that the apartments rent sufficiently and then the retail rents at below market, or the office, or any sort of light distribution space. The only way the economics is going to work to build new is all of those have to work. And I think that's why we've seen, for example, Westwood Station has been successful. You have apartments, you have hotel, you have medical, you have retail, restaurants, train station, because all the rents in each of those categories of uses are sufficiently high that you can warrant new construction. I think it's much more difficult as you go further down Route 24 to be able to warrant new mixed, use development, just because the rents aren't sufficient. I think David talked about office rents, that I think have been flat in Route 24 for 20 years. Retail rents have been flat for probably 15 years. It's very hard to do new. I think the opportunity there may be, though, in the Fall River, New Bedfords, even parts of Pawtucket, for example, where there are still some masonry mills left to be developed, where you can get historic tax credits, you can get a TIF, you can maybe even do new market tax credits and possibly convert those. Unfortunately, in Brockton, there really aren't any mills of consequence left where you could do mixed. They're not really big enough to do mixed use, or they're wooden, which is less desirable. So I think I'll stop there and turn back to Fred.
Gerry, thank you, especially if the commuter rail gets extended to those communities. I think you've underscored the opportunities that seem apparent, but what you also underscored as what's certain is really the uncertainty, which is keeping some people in a wait and see mode. So we'll see if the wait and see mode is applicable to our next speaker, a property owner, Jeff Anatole. Jeff, we got about 10 minutes or so, and why don't you give us your sense of redevelopment opportunities, new development, and the type of returns and outcomes that you're seeing. Go ahead, Jeff. Jeff, you're on mute.
Sorry about that. Can you guys hear me?
Yep.
Gerry, I think you left me at the perfect place to take over from what you just said, and regarding new construction, new development, south of Boston, Route 24 area, and essentially you need to have the rents to justify the development. A lot of times that's difficult or impossible to make work, and as a developer, my company's been able to leverage programs such as HDIF, historic tax credits, TIFs, opportunity zones, which Jay will speak about, to kind of make the numbers work, in addition to us acting as the general contractor and not having those fees. The most recent development we finished was 44 units. We opened up about 2 weeks ago. Can I share my screen here? Is there a way to do that? Or no?
That's Rocco. Rocco, can you let him share his screen?
Well, anyways, I was going to show a picture of the new development, but the last place we finished was 2 weeks ago. It's luxury apartments. They're located right in downtown Boston. We opened up 2 weeks ago. We have 5 units left to rent. The market does exist. We're renting during the whole coronavirus pandemic, and it hasn't really impacted us too much. I think if you have the right product in the right place, and the demand will come. One of the reasons we specifically have been building in Brockton is because of the commuter rail. Gerry, you just mentioned you think there'll be development in areas like Hahn, New Bedford, just south of those areas, and Brockton is kind of right in between. So the opportunity's here, but you're right, the numbers don't work. So HDIP has been something that's been critical to us too. We use it on the last 2 projects. Secretary Kennealy, please don't stop that program, expand it, let it grow. That really has been the catalyst allowing us to do these developments, allowing us to do the new construction. All the other factors are, contributory. They've added, there's impact on them, but without HDIP, none of them would have happened. So in regards to development opportunities, I think they always exist. They're available. I think going back to what you said, Dave, about rents maintaining where they are right now, I think that rents are stable. I mean, we manage several hundred units as well, and rents are not going down. They are stable, but typically when we try to do 3 to 5% annual increases, I don't see that happening over the next year or two. I think that things will just kind of remain as they are. Hopefully, the courts will open up soon. Hint, Secretary Kennealy. Maybe that's not funny. But I think development opportunities exist. I think where they're close to a commuter rail, like the Westwood 138 development is a good example. You have a good amount of mixed use and new construction, but there the rents in Westwood are double that at Brockton. So how do you make the numbers work? And again, that's where all these kind of opportunity zones, HDIP, TIPS, all these other programs, or Rob May's 7-layer cake, when you're able to put them together appropriately, you can make them work. I have an emphasis on market rate housing, so LIHTC and some of those other programs are not something we're able to leverage, but HDIP, opportunity zones, and again, just combining it all, the opportunities are there. With that said, Gerry, I agree with you that new construction is expensive. We GC the project, so we're not paying that 30 or 40% overhead you have with a general contractor, even though they say it's 15%. It's not, because you have the profit, overhead, markup, contingency, all said and done, it's 30 or 40%. So as a general contractor doing it ourselves, we don't have that overhead, and it's still tough to make the numbers work. So the opportunity does exist. It's just a matter of what you want to do, how you want to do it, and making the numbers work. Like I said, I'm emphasizing Brockton because where our last 2 projects were, but when you're close to the commuter rail, I think the market's going to exist regardless. Half the renters that have moved into our new place are not from Brockton, and that's kind of what we anticipated. It's people that are coming from Dorchester, from downtown, that were paying significantly more and getting significantly less. So there is a lot of opportunity. I think interest rates where they are right now also present a lot of opportunity. To be able to finance a project under 3% is remarkable, but one of the issues with that is, there's always a give and a take, and the cost of lumber right now has tripled. So, you save here and more there. So it's kind of you got to put it all together. But I think there is a lot of opportunity. I think the current market presents a lot of opportunity. The interest rates I hope they stay where they are, and we can leverage them while getting lumber at a decent price. Maybe we'll go to steel, Gerry. I don't know. But the opportunity does exist, and I just think if you're able to put the right kind of pieces of the puzzle together, it's prime for the taking now. We'll see what happens moving forward, but again, I think there's a lot of opportunity for areas south of the city, and the pandemic has probably helped some of the residential areas too, where everyone's looking to get out of downtown Boston but still have access to it. So how do you do that? Live near a commuter rail. So
Geoffrey, would you show folks the building? You can share now. So Geoffrey's completed 2 projects in the last 18 months. Construction was not halted in Brockton, so we thank the mayor of Brockton for doing that. It allowed Geoffrey to be in on time and get his units rented in the brand new building in downtown Brockton. But he also renovated a mill not long ago. So Both are really impressive success stories. And yeah, also just to note with the panelists, this is the first Opportunity Zone certified project, this new construction south of Boston. And he was able to get that in and access those incentives as well.
Chris,
So how do I share my screen here?
Geoff, what I might suggest is that you in the chat put a link, a web link, so we can see and kind of take a look at it as we go forward. And,
good idea.
Yep.
Last thing I'm going to add here too, regarding what Chris just said. So yeah, I mean, federal tax credits, historic tax credits, they were important on the renovation. They've changed, I guess, the rules on that now, where you can't recoup some of the money in 1 year. It has to be spread out over 5. But the Opportunity Zone has added a lot of value as well if you're a long-term holder. So it really depends on what you want to do. But I'm sure Jay will speak about this as well. The Opportunity Zone is not as simple as people think it is. We spent a lot of time, developing essentially the org chart with Cohn Resnick, and we had attorneys from like Clyde Hornig, review it. Jay's probably kicking me right now. Why didn't we call him next time? But it's not that simple to put together. There's a lot involved, and I think people underestimate, what it actually takes to put the correct, infrastructure in place to be able to take advantage of the actual Opportunity Zone benefits that exist. And again, Jay will, I'm sure, speak about that in further detail.
Geoff, thank you so much. And we're getting closer to the secretary. I'm a little worried, Mr. Secretary, because we have 2 lawyers in between. And as a fellow attorney, that does concern me. But we have about 10 minutes for a presentation from Jay Peabody, a commercial real estate attorney and also a partner, and Russ Stein of counsel, both of which are at Partridge, Snow, and Hahn, to talk about opportunity zones, shifts that they see, and any outcomes or examples that they may want to share. We'll start with Jay. Go ahead, Jay.
Great. Well, thank you. And thanks for presenting this, both Metro South and New England Journal, both great local partners to lots of our clients and all the folks on this panel today. So we really do appreciate it. I will try not to be wordy. Russell is usually the chatty one. He's a tax guy. But we do want to talk about opportunity zones. But at the same time, I know I want to talk a little bit about sort of some client trends and some shifts. And the reason that I want to talk about it specifically today is because I think it's a real enhancement to the suburban markets and can be to the Metro South market. So the way I've been looking at things, and we've been very lucky. We've been busier in the last 2 quarters than we've been in a long time, and partly because we have some very active clients, and we have some capital markets work, but we do a lot in the suburban markets with mid-market clients. So, the reality right now is the capital markets are nervous, very nervous. And when I talk about capital markets, for us, it's Boston. And there's lots of reasons for that. But if you've been following trends and some of the larger brokerages, CB, JLL have been very active. Colliers has been very active in terms of getting information out there. If you look at this point, we've now read, and we've all read ad nauseum, that I think about half of the workers that previously sat in Boston do not anticipate returning to Boston, and their employers aren't going to mandate that because, frankly, you can't. I think it's Mass Competitive Partnership did a poll. A number of other groups did a poll. And 50% of a workforce is absolutely as dramatic as I think I could have ever guessed. I would have, if you had said, what do you think? I would have thought maybe a third of the workforce tops, but 50% is a huge amount. And then at the same time, as you think about the work environment and the economy, those workers, my guess, aren't going to all want to sit at home. Some might. But the old brick and mortar office is not going to go away, and that's the favored part of the trend that really hits and impacts the suburban markets. On top of that, I don't know if you guys read this week, but JLL came out and said that there's full absorption in East Cambridge for R&D. Well, that's a wonderful boon to the burbs because biotech has always been sat in the Cambridge submarket. And I've had calls this week from 3 or 4 suburban owners that said, we're sitting on X acreage, and we really think we want to potentially put together a pro forma to build out some R&D or small biotech. I mean, what a boon to a suburban market. That's been something that they've been wanting for, upwards of a decade. So, just those kind of trends that we're seeing in the market are shifty, but they are true benefits to submarkets. So I think Dave Ellis talked about the submarkets, whether it's the repositioning of existing assets or trying to develop ground up something that might already exist. We're seeing an uptick like I haven't seen in quite a long time. So I think that's great. Credit is totally different. So Gerry talked about credit. The banks are out there. They have great leverage in terms of rates today. But the covenants are different. So what does that mean? It means you have to enhance your project. It means you have to figure out what type of alternative vehicle you can pro forma into your project. So Jeff did it with opportunity zone and tax credits. That's a great way to do it. Equity, another great way to do it, in the sense of we've had many clients call us and say we'd like to start fund X for a suburban redevelopment program, and we'd like to raise equity both in the traditional sense where we want to go to our friends and family, maybe even to the market, but we'd also maybe like to talk to you about an opportunity zone fund. So there's these two threads of equity in the market now that are able to get Gerry and his team or other bankers comfortable with that that lower loan to value, which they're going to require. My understanding is, some banks are as low as 50% loan to value, and some aggressively, 65, 70% at tops. But I think you're really pushing the limits at that point. So you got to figure out ways to make that project work where you can't lever debt in the traditional way that you might have. So, credit is different, but I think it does create an economy that is terrific for Metro South and others. I do want to give a chance for Russell to talk, because opportunity zones are absolutely a way to enhance that credit. It's a way to do a project if funded or if structured properly. And part of what Russell can talk about is how that happens. We could do a whole nother forum and have for the Metro South on opportunity zones. So we're going to leave you with a bunch to think about. But the key to those projects are commencing your project with a fund in place and doing it the right way. So it's the diligence on the front end that enables you to have the successful project and implement an opportunity zone as a credit enhancement like Jeff's done. But you got to start early. So Russell, I don't know if you want to tie out from that and maybe give an illustration, or I'm not sure exactly how you want to approach it.
Sure. No, that's a good segue into the opportunity zones. And as Jeff said earlier, these are really long-term investments. The Metro South area is lucky to have quite a couple of opportunity zones. There's some in Randolph, Brockton, Bridgewater, a little farther out in Abington and Taunton. And for the real estate play, the opportunity zones is really where it can enhance an investment. If, as you know, or for a brief summary of opportunity zones, it allows investors to have three major tax benefits. One is to defer capital gains from this year until 2026, so you get 6 years worth of tax-free money. The second is to limit some of that capital gain. You'll get 10% of that excluded permanently. And the third, the major one, is if your project appreciates and you hold on to it for 10 years, 100% of your appreciation is completely tax-free on the federal level. Not so much on Massachusetts state level, but on the federal level, this could be a huge benefit, especially if taxes go up. If the capital gains rates go up from now 23% or so to ordinary income rate of 45%, you can have a huge savings as long as you sell the property by, I think, sometime in 2040s, I think 2046 or something like that. But as Jeff mentioned earlier, there are specific technical details that you have to be aware of. First, the property has to actually be in an opportunity zone. And the opportunity zones are not based on zip codes, but based on tract numbers. So we've seen some people thrown off a little because they thought a whole zip code, such as all of Brockton, was an opportunity zone, and that's just not the case. The property has to be purchased in a specific manner. You have to be careful with your cash flow in the property after you buy it to make sure that you can meet certain IRS regulations. And most importantly, especially for the community, you have to substantially improve the property in most cases. The government doesn't want you to just go and buy a building or a piece of property and sit on it for 10 or 15 years. They're basically requiring you to put 100% of your basis in the building into improvements over the next 3 years. So the intent is really to improve the building, improve the community, and have everyone benefit. So we do see a lot of interest in this. At first, it was really for commercial real estate, but it will work for residential real estate in the apartment area. It won't work for selling townhouses or condos. It's got to be some sort of rental property. And it is a good portion of that 7-layer cake. You stack it on, if you already have a good investment and it's going to be in an opportunity zone, the opportunity zone tax benefits could turn it into a great investment. Won't turn a bad investment into a good investment though, but it will still turn a good investment. It will sort of be like icing on that 7-layer cake.
Well, Russ, what I was hoping is maybe if you wanted to, I think as Jeff did and others have done, if you want to take a example from a prior slide and drop it into the notes. I think sometimes with programs like this, it's often nice to see illustration and then it sort of enhance the concept. So if you want to do that as part of the notes while Secretary Kennealy is talking, that might, oh, you're going to bring it up. Okay.
Yeah, I brought it up. Not sure how to get rid of it once I brought it up, but this is a general slide on how the opportunity zone works. So basically, you have to first generate capital gain by selling a property. You need to form a holding company, which is what we call the Qualified Opportunity Fund, or the QOF, and then that holding company has to buy the building and substantially improve the building. And if you do that over the years, you get those 3 tax benefits. But if like any tax program, if you have a foot fault, you're going to lose all the tax benefits. So if the person who or if the entity that generated the capital gain is not the actual entity that buys the property, all the tax benefits disappear. And it's very difficult to unwind that and fix it because there's a whole bunch of related party rules. So in the beginning of the planning, it can be done after a letter of intent is signed, but it has to be done before the actual purchase is taking place.
Russell, and I want to just remind everyone, and if you look in the chat function, we've actually included a presentation that you've made regarding the opportunity tax zone benefits. There is a quiz at the end. We're grading it here at Bridgewater. But I want to thank my brothers at the bar. Jay, Russell, thank you so much. We want to give time to our esteemed guest, the Secretary of Housing and Economic Development, and our good friend, Mike Kennealy, to give us the state perspective on what he sees and what the state sees for development and economic trends. Mr. Secretary, you should know a couple of weeks ago, we had our joint friend, our mutual friend, Bobby Coughlin on.
Oh, great.
It was a terrific, I mean, as you know, he's low energy, but he gave a terrific description of what the opportunities are for mass biotech as well. But with that, Mr. Secretary, please help us.
Oh, President Clark, thank you so much, and great to be on this very talented panel. And I have to say, it's great to be part of a discussion where we're focused on how we're going to build and how we're going to grow and how we're going to move forward after what's been a very, very challenging time for all of us. I'll spend a couple minutes on the challenges and where we are, and then I'll spend more time on our plan for growth coming out of this. But obviously, it's been an enormously challenging time economically for the entire state. We were and are among the hardest hit states by COVID-19, and the decisions we took to help improve our public health outcomes obviously had dire economic consequences. And so if you look at our economic stats the last few months, At one point, our GDP declined, gross state product that is, declined by about 44% on an annualized basis. Our consumer spending went down 40% between March and April. Wage and salary income down about 11%. Unemployment peaked at about 17%. And this was coming off a period of time when the economy was just firing on all cylinders. And so in the first 5 years of the Baker-Polito administration, we added a couple 100,000 jobs. We had unemployment below 3% for a long period of time. And we know what the drivers of our success have been, and they'll be the same going forward. We're a number 1 innovation economy globally. We're financial and intellectual capital of the world. We have tremendous companies, tremendous communities, and these would be our sources of strength coming out of this. But make no mistake, it's been a tough time economically in Massachusetts, to say the least. And in particular, perhaps for our small businesses and a lot of our Main Street businesses. So maybe I'll spend a few minutes and talk about how we look at the way forward here. And I think there's really 5 things we need to focus on. One is to continue the reopening process. I, along with Lieutenant Governor Polito, co-chaired the Governor's Reopening Advisory Board. We came out with a report on May 18th. And after a period of time when many businesses were closed, we came up with a phased, data-driven approach to reopening the state's economy. That process started on May 18th. We're now into the 3rd phase of that reopening process. But we ought to continue to assess where we can reopen more activities. And I will say it's been during a period of time when much of the state's economy is reopened, we've seen great improvement on the public health metrics. And so we took these very tough decisions early on, really to limit activity and limit contact among the public. And that had tremendous impacts on the limiting the transmission of the virus. But even since we started reopening, our positive test rate was about 11% on May 18th. It's now below 1% today after reopening a big part of the economy. And that is really a testament to the commitment of our individuals, our citizens, our communities to doing the things we all can do to limit the spread of the virus. And we've seen just tremendous buy-in from employers and everybody really on doing those things around face coverings and maintaining distance, and businesses following the detailed protocols that we outlined in our report. So continuing reopening will be part of our strategy. Support for our small companies, we need to do more of that. We recognize that. I'll talk more about some specific ideas we have in that regard. 3rd is getting people back to work. At one point, we had 1 million people that were out of work. We've seen some recovery in that number today, but we do worry about the workforce long-term and are developing strategies and getting people back to work that have been unemployed now for some time. The 4th item is around building and investing in our communities and in our housing. You know, we were using the term housing crisis here in the administration long before we knew what COVID-19 was. So we simply have not been producing enough housing in the Commonwealth. It's great to hear from Jeff and others that are building housing because we need it. And so building more housing will be important to sustaining economic growth going forward and to meet the needs of our citizens. And investing more in our communities will be important. We've been big investors through our MassWorks program and other programs, committing hundreds of millions of dollars of state capital to helping our communities realize their development aspirations. And that'll be a big part of it. And the 5th item I want to talk about is the innovation economy. And I'm glad we've had some discussion already about life sciences on this call. This is the engine of growth for us. Always has been and always will be. It's got tremendous impacts, not just here in Boston, but statewide. And we will continually aim to make sure we have a leading position in life sciences and software and advanced manufacturing and lots of other areas. And that will be our path through growth going forward. We have an economic development bill before the legislature now that would give us some more tools to execute this agenda. I'm glad to hear Jeff mention the HDIP program. We propose to triple the size of the HDIP program. It's been an enormously important program in our gateway cities to get more market rate housing built. We're looking to have more tools for neighborhood stabilization, to build more transit-oriented housing. I think these will be a good complement to the tools we have in our toolbox already, in addition to hoping to have more capital to help sustain our small companies and more programs for workforce development. Back on life sciences, we have been tremendously committed to the life sciences ecosystem really since the start of the administration. The governor in June of 2018 signed the life sciences reauthorization bill, extending the work of the Mass Life Sciences Center. It's a $473 million capital bill, and then another $150 million in tax incentives as part of that. And our focus on life sciences is really in a few areas, helping to really push the science and push innovation through capital grants to our research institutions, really making sure we think regionally about life sciences. We've been very focused on making sure this is an opportunity for the entire state, not just here in Eastern Massachusetts, in Boston and Cambridge, but this is an opportunity really for every region of the state. And we've been very focused on, for example, life sciences manufacturing as an opportunity today that literally spans from Boston way out to the western part of the state. So thinking regionally about life sciences is important. Investing in human capital, trying to build our talent pipeline in life sciences, always has been, always will be important to us. We probably have the most successful life sciences internship program in the world here in Massachusetts. About 5,000 students have benefited by this program over the last 10 years. That's helped build our talent pipeline and build a more diverse talent pipeline for that matter. So human capital will be important. And of course, the center's played a role in helping to formulate our response to COVID-19, and we'll continue to do so. So we'll continue to commit capital, continue to help build the workforce in life sciences. And we're in discussions with companies all the time about expanding here. For any company wishing to expand in Massachusetts, we have a number of tools in the toolbox. The MassWorks infrastructure program mentioned is helpful for companies to develop their sites. The tax incentive program can be helpful for companies making a cost-benefit decision of relocating here, working with our state universities and community colleges and others to help build a talent pipeline, help build those relationships with companies looking to build their workforce here. We love to have that dialogue with companies that want to expand. And I will say, even during this time of the pandemic, that activity has not really abated. It's sort of full steam ahead for life sciences and helping to build out here. Last couple of things I'll mention that I think are interesting topics. We started something a couple weeks ago. I participated in something called the East-West Exchange, and it was an effort to get manufacturers in the eastern part of the state talking to manufacturers in the western part of the state, as companies might be rethinking their supply chains here in the COVID-19 crisis. And so helping to develop those supply chain relationships where a company can find a partner across the state versus across the world. I think that's an interesting initiative. And then speaking of manufacturing, I always like to highlight the work of our manufacturing emergency response team, where our advanced manufacturing collaborative, which I co-chaired, put the call out to Massachusetts manufacturers to see if they could repurpose their production lines and make face shields and masks and gowns and the products our first responders and healthcare workers needed. To date, that's been 50 companies that have participated in that, and they produced about 5.5 million pieces of PPE so far. So that's how we're looking at the world now. It's been an enormously challenging time. We do feel like we have a plan to continue our growth that was so robust before this period of time. And I'll close by saying that our new economic, well, not so new now, but our economic development bill we developed at the end of 2019 was called Partnerships for Growth. And we picked that title on purpose because it really speaks to how we all work and think and plan to do things together. We're a place that is enormously collaborative across government, business, academia, at all levels. And that ultimately is how we'll find economic success going forward.
Mr. Secretary, thank you so much for that overview. Do you have a minute or two for a couple questions?
Sure.
Good. Well, first of all, Bridgewater, we bought our mask PPE from a company in Fall River, 20,000 of these that have repositioned themselves to serve the people of Massachusetts. So it's
great to hear.
We also want to thank you from the Chamber and everyone on this call for the state continuing its construction of the state building on Main Street. It's a gateway building, and we're really grateful that the construction is moving forward. We call it the old Ganley building, but that is kind of a symbolic commitment of the state. I just wanted to ask you very quickly, you mentioned a lot of resources, which is terrific. Is there a place for folks to go, kind of a clearinghouse that the state has on a website or what have you, where they can kind of analyze all those resources?
Yeah, it's a good question. I think if you look on our website for EOHED, there'll be a number of things there. The Life Sciences Center has its own website and an inventory of their programs. But I'd start with our website here at HED, Housing and Economic Development. And of course, we all the time, we're having direct dialogue with our community and business leaders about how we can deploy our resources. So we certainly welcome that as well.
Mm-hmm. Secretary, just the last question. We talked a lot early on about companies and commercial entities maybe moving south of Boston or outside of Boston. and to get closer to where their employees live. Do you imagine any incentives to help folks have satellite offices or to relocate? Have you been able to get your arms around that, or are you waiting a little bit longer to see how it shapes up?
Well, I will say, President Clark, it's always hard for us to think about providing incentives for companies to move from one community in Massachusetts to another. If it's a situation where a company is looking at moving out of state versus moving somewhere else, that might be a different dialogue. But it's for the most part, we're trying to grow jobs within the borders of the state versus trying to move companies around. But we will be watching these trends very carefully, as you can imagine.
Excellent. That makes perfect sense. I want to thank our panelists. Mr. Secretary, thank you for joining with us and for listening in. I want to give the last word to our host, Rick Kaplan, and the New England Real Estate Journal.
Thank you, Fred. Thank you, Secretary Kennealy. Always a pleasure to see you.
Great to see you.
We did miss you this year in the Middlesex 3 because the pandemic just happened to break out at the same time we were having that meeting.
That's right. That's
it's
right.
Good to see you.
Great to see you. Thanks.
I want to thank the Metro South Chamber of Commerce, always a great partner. This is an annual thing we do. This has been a great panel discussion today. This is a lot of great information on the Metro South region. Fred, you outdo yourself. You're a great moderator. I appreciate you doing this every year. And I can tell you that the audience really enjoyed this panel. I can see them through my crystal ball. They're all standing and applauding right now. So you should all take a pat on the back. We appreciate it. I want to thank our sponsors, Rockland Trust, US Pavement, who is our annual sponsor. Without them, we can't do this. I also want to mention, again, we are doing a spotlight on this Metro South region. These spotlights that we do whenever we do webinars is very important to cover what's going on in this region. What a lot of people don't realize is the New England Real Estate Journal is basically going out throughout New England. And because of its digital presence, it's also seen all over the world. So when people see the content that we put out, it does drive them, they look for more information about what might be present in that particular issue. So we do encourage people to reach out to the New England Real Estate Journal, myself, Rick Kaplan, or if you're interested in this Metro South region issue, also Chris Mooney's organization, the Metro South Chamber of Commerce. This is an important issue. And like Secretary Kennealy said, we want to try to encourage more growth in the area, and this is a way we can do it. So we hope everyone that is on this would be interested in participating in this issue. I want to thank everyone today. Great panel. I also want to wish everyone a happy, healthy Thursday afternoon. Have a good day. Thank you for watching today's interview. If you'd like to be a guest, a sponsor, or even advertise in the New England Real Estate Journal, you'll find our contact information in the description box below. You can also find all our social media platforms so you can follow us, and please subscribe to our YouTube channel.